I don't think people have understand the amount of effort that it takes to be a leveraged trader. I think people say, "Oh, I can get 100x leverage or whatever trading crypto, versus I can get 2 or 3x trading stocks or some leverage ETF. This is great. I'm going to make a lot of money." But they're not willing to put in the effort to be a professional trader. But that what I mean, like 24/7 on your phone, like you live and breathe these crypto markets. People think that, oh, I'm going to get off of work and trade leverage crypto for a few hours and I'm going to somehow make money. No, you're going to get liquidated. And if you're just trading crypto a few hours a day, you're not reading, what is an automatic deleveraging event, how do exchanges mark your positions. And you don't understand these idiosyncratic things about the market structure that you should as a proper professional trader if you put all your effort into this. And that's where most people got wrecked in October 10th.
Bitcoin trades around $93,000 as of early December 2025, down over 17% from its November close, amid weak ETF demand and bearish on-chain signals, such as whale transfers to exchanges. Analysts are eyeing $80,400 as a key support level. A close below could trigger deeper drops towards $71,500 or even the mid-60s, while reclaiming $97,000 might spark a recovery past $100,000. Meanwhile, MicroStrategy slashed its 2025 earnings forecast, citing Bitcoin's slump from October highs near $126,000, now projecting end-of-year prices between $85,000 to $110,000. Arthur Hayes explained in a recent interview how many traders underestimate the grind of leveraged crypto trading. They chase 100 times leverage, far beyond stock or ETF options, expecting quick riches without committing full-time effort. Casual players log off work and trade a few hours, ignoring essentials like auto-deleveraging events or how exchanges mark positions. Hayes stressed that professionals live and breathe these markets 24/7, dissecting microstructures to avoid wipeouts, as seen in the October 10th liquidations that wrecked the unprepared. Without that dedication, high leverage just leads to swift losses. Stick around as we bring you more clips from Arthur Hayes' interview. Please don't forget to like, subscribe, and enable notifications for additional in-depth content. Thanks for joining us again. Enjoy the rest of the video.
If you take a look at, I have an index on Bloomberg if clients have access to that. It's the US dollar liquidity index, and it's essentially a combination of certain indicators on the Fed's balance sheet, which was published every week, and then certain indicators from the US commercial banking system. And the reason why, at least in 2025, I've been really focused on the United States is the other three large money printing protagonists, the EU, Japan, and China, haven't really been doing all that much. And it's really been about the United States and everyone's reaction to what the United States has done. And so that's why I've really focused on this particular economic block for, the whole year. And when we talk about the dollar liquidity, my chart basically showed that, year to date, there's been an actual reduction, a net reduction in the amount of dollars circulating, at least by my index that I look at, and I use to guide my investing over the year. But what we saw from sort of April 9th until, October was Bitcoin hitting an all-time high. And this was driven by, I think, people misunderstanding what's going on in the ETF space, especially the IBIT ETF, the BlackRock Bitcoin ETF, the largest ETF out there that tracks Bitcoin, and the digital asset treasury company space, the DAT space, and the issuance of debt and stock to purchase Bitcoin. And these two things essentially added the impression that there's this big institutional bid for Bitcoin. And therefore, the Bitcoin sort of ignored the fact that about $1 trillion was removed from the dollar liquidity markets at least from July until the present. And basically, once the ETF inflows switched to net outflows and DAT companies went from trading at premiums to trading at par, if not a slight discount, then Bitcoin basically fell down to where it should have been based on the dollar liquidity situation. Take the ETF, for example, because this is one of the most shown charts that inflows every day on X and other social media platforms. And people say, hey, look, Wall Street, retail, they're piling into these ETFs. And yes, that is true. But as traders and investors, we care about who is the marginal buyer and seller of a particular asset. What are the flows? And so, I have my trusty Bloomberg chart up here. You put up an HDS, the largest holders of the IBIT ETF on Bloomberg. or whatever platform you use, you'll see, and I'll name them here: Brevan Howard, Goldman Sachs, Millennium, Avenir, Jane Street are the largest 5 traders of this thing. Right? There's a chart in my recent essay.
That's right.
And if you understand anything about what these businesses are, they're either multi-strat pod shops who trade hedge funds, they're global investment banks, and one of them is a family office for the founder of Huobi, Avenir. And so these entities are not places where they're just going to go long Bitcoin. Like Izzy doesn't give a about Bitcoin. Alan Howard loves Bitcoin, but it's not like the key thing in his Brevan Howard asset management company where he manages clients' money. What they're in the business of doing is borrowing money and finding great ways to deploy that with, high Sharpe ratios. And that would be a basis trade. So what are these guys doing? They're taking the IBIT ETF, they buy it, they pledge it with their broker, then they sell a futures contract on the CME against it, and they were making, let's call it 7 to 10% per annum on that trade. They fund at Fed funds at 4-ish%, and they lever it up, and that's a great levered return for these type of investors. Now, as that funding rate declines, and it has declined in September and October, then these traders unwind this position by selling the ETF and buying back their futures contracts. So during the summer, we saw massive net inflows driven marginally by these large players. And then as soon as that basis fell, especially after October 10th on the massive liquidation event, then you see net outflows. And so the retail thinks, oh no, institutions love Bitcoin in the summer and now they hate it in the fall. Therefore, I need to get rid of my exposure as well, not understanding what was driving those flows in the first place. And then on the DAT space, if you have a low MNAV or even at a discount, it's very difficult to issue corporate securities and purchase Bitcoin in a net positive accretive manner for your stock. And therefore, either you stop doing it altogether, you slow down, or you start selling Bitcoin and buying back your shares if you're trading at a discount, which again removes this impression that there's this new cohort of assets or of capital that is coming into the Bitcoin space. So when we remove those two things, and then I post that, you posted my chart of the difference between the price performance of Bitcoin and the percentage change in the dollar liquidity, then Bitcoin says, okay, I'm going to react to where I should have been absent the shimmer of these flows. And that's the move from 125,000 to 80,000. So in 2023 and in 2025, there is a political theatrical fight about the debt ceiling in the United States, where both in 2023 it was the Democrats in charge, in 2025 it was the Republicans in charge. Same issue. One side wanted to spend a bunch of money and raise the ceiling. The other side tried to feign that they gave a about fiscal responsibility, and so they fought the opponent. And then at the end of the day, of course, the government's not going to go bankrupt itself by not paying out. So they raise the ceiling. But all the while that this debate, this fight goes on, the Treasury has to spend down its checking account. And when the U.S. Treasury, or any Treasury department for that matter, spends down their checking account, they're adding fiat liquidity to the system. And so this is helps the markets. But as soon as the ceiling is raised, now the Treasury needs to refill its bank account. And by doing that, they issue debt. And instead of spending that money that they raise from the market, they keep it in the bank. And that extracts liquidity. So in 2023 and in 2025, it was June in 2023 and July in 2025, you had in the order of, half a trillion to $1 trillion that needed to be raised by the U.S. Treasury. And so as they start to do this, then the dollar liquidity contracts, and this has an adverse effect on all types of risky assets, Bitcoin and stocks predominantly. Now, in 2023, this led to sort of a 20% sell-off pretty quickly in the S&P. The 10-year yield was rising almost close to 5%. And again, the goal of every administration in the United States and every government around the world is to keep the stock market high because they earn taxes and makes the rich people feel good and all these sorts of things. So Janet Yellen had to find a way to juice the markets. Now, back in 2023, there was this facility at the Federal Reserve called the Reverse Repo Program, and it had $2.5 trillion of funds basically left over from the COVID stimulus era that was sat inert on the Fed's balance sheet. So what Janet Yellen did was said, okay, I'm going to issue more Treasury bills, short-term Treasury debt, less than 1 year maturity, and such a quantity that the yield is going to rise so much so above the reverse repo yield that it'll entice those funds to take that money out of the Fed's bank account and put it into the financial markets by lending it to the U.S. government, which then goes and spends this money. And so from 2023 third quarter until essentially January 2025, Janet Yellen's Treasury injected $2.5 trillion of liquidity into the US dollar money markets. And that is essentially the reason why everything across the world ripped. Bitcoin, stocks, gold, housing, whatever, right? That is the reason for that bull market. And that sort of ended in early 2025. And so between that and the Fed's program of quantitative tightening, where they basically are reducing the size of their balance sheet, we're talking about close to $1 trillion was taken out of the dollar money markets from July to the present moment. And that is essentially the negative drag from a liquidity perspective on Bitcoin and other risky assets.
The U.S. Dollar Liquidity Index on Bloomberg tracks key Fed balance sheet metrics, released weekly, alongside U.S. commercial banking indicators. In 2025, focus stays on the U.S. since the EU, Japan, and China have eased money printing, making U.S. actions the main driver of global reactions. Year to date, this index shows a net drop in circulating dollars, guiding investment choices, yet Bitcoin surged to an all-time high from April to October, despite roughly $1 trillion pulled from liquidity markets since July. That rise stemmed from misread ETF flows and digital asset treasury DAT firms issuing debt or stock to buy Bitcoin, creating a false sense of institutional demand. Top IBIT holders, mostly hedge funds and banks, ran basis trades, buying the ETF, pledging it, and shorting CME futures for 7 to 10% annualized returns, funded at around 4% Fed funds rates. As funding rates fell in September-October, they unwound by selling ETFs and covering futures, flipping inflows to outflows post-October 10th liquidation. In 2023, Treasury issued short-term bills to lure $2.5 trillion from the Fed's reverse repo into markets, fueling a bull run ending early 2025. Combined with Fed quantitative tightening, this extracted nearly $1 trillion in liquidity since July. Bitcoin then corrected from $125,000 to $80,000, aligning with the index. Let's watch more clips from Arthur Hayes' interview.
What are some of the biggest lessons that you think crypto traders are still learning or still haven't learned?
I don't think people understand the amount of effort that it takes to be a leveraged trader. I think people say, I can get 100x leverage or whatever trading crypto versus I can get 2 or 3x trading stocks or some leverage ETF. This is great. I'm going to make a lot of money. But they're not willing to put in the effort to be a professional trader. But that would I mean like 24/7 on your phone. Like you live and breathe these crypto markets. People think that, I'm going to get off of work and trade leverage crypto for a few hours and I'm going to somehow make money. No, you're going to get liquidated. If you're just trading crypto a few hours a day, you're not reading, what is an automatic deleveraging event, how do exchanges mark your positions. And you don't understand these idiosyncratic things about the market structure that you should as a proper professional trader if you put all your effort into this. And that's where most people got wrecked in October 10th. It wasn't some conspiracy by CZ and Binance and the market makers to take away your money. It was you were lazy. You didn't read the documents that have been up for years. I mean, I invented this shit 10 years ago. We wrote about it. You should have no excuse not to know what this stuff is and how it works. And if you didn't agree with the exchange policy, you should never have been trading it. So I have no sympathy for people who lost money in October 10th, except for people who had API issues on Binance. There's no excuse. If you are a proper trader, you should not get liquidated, period. End of story. It's just a maturation of the market. There's more people trading these things. There's more newcomers. They haven't decided what they want to be. They're a hobbyist. I get off of work, I trade crypto. I think that I can grind the chart and I'm going to make however much money I'm going to make and it's going to change my life, which it could if you're very, very lucky. But if you don't put in the effort, like I described, then you will get wrecked, period. And you're not reading the documents. You don't understand the flows. You don't understand how these products work. You don't understand the math, yet you think that somehow you're going to make money in this. And so I think that it's a misalignment of expectations versus effort that people are willing to put into this thing. Being a professional trader is a job. And if you approach it like that and dedicate yourself to it, then you can be successful. I was very thankful that, I know people tracked some of my smaller wallets, that some of these coins did revisit those lows. Because I basically, when I changed my view as to, constructive on market risk a few days ago, I was able to go in and pick up things at prices that I haven't seen since, April of this year or before then. Right. And I look at the charts like, okay, this is the low that it's ever reached. great. I'll buy some Pendle. I'll buy some Athena. I'll buy some EtherFi. Great prices, because people sort of got, smoked on 1010. And these are projects that have buybacks. These are projects that are profitable. These are projects with users, and they're trading at great prices. So I'm very thankful that, they did revisit those prices, because I was able to buy things at what I think are very affordable and cheap prices relative to where they should be, given, the fundamentals of the cash flow that these things generate.
Are you buying ETH?
I'm not buying ETH right now. I have a big ETH bag of ETH. I think these things will outperform ETH in the short term.
You think the alts will outperform ETH?
Yeah.
Okay. Which, like some of the ones you mentioned, like ENA and stuff like that.
Yeah, exactly.
Okay. Do you still think ETH can get to 10K? Because actually, I have to tell you something about Milk Road. When you go to our YouTube as a returning user, the clip that opens is literally you with Jay a month ago saying, "Yeah, ETH can go to 10K."
It absolutely can go to. It absolutely can go to 10K. I think that the Tom Lees of the world, he's spinning a great narrative for his user base, which are TradFi asset allocators and heavy retail traders in the Western markets. And his thesis is, okay, banks all of a sudden now want to do Web3. The most secure chain to do Web3 on is Ethereum, and therefore either they'll build their own L2 or use L2s that are out there, or use the Ethereum mainnet in and of itself. And this is going to drive usage of the chain, and that's going to be the institutional DeFi narrative. And I like that narrative. Whether or not it's true is kind of irrelevant. I think it makes sense to the people that he's selling it to, and coupled with a supportive macro environment, this will be what generates ETH to the $10,000 to $20,000, I think, price by the end of the cycle. I don't know what indices that MSTR is including, because they didn't make it to the S&P, right? I'm not sure if they're in the Russell or not. I think a lot of these large indices have sort of poo-pooed them and sort of not really added MSTR for whatever reasons. They have their reasons. Some good, some bad. I think this is sort of a nothing burger thing, this MSCI exclusion or inclusion. I'm not sure whether they're in or not. I don't know if maybe JP Morgan's portfolio trading desk probably has a massive rebel position on the stock, and he's just trying to jobbo them into putting them in because they're going to make a ton of money if they get included. I put that more as probable than anything else. Rather, why is Jamie Dimon opining on MicroStrategy? This man runs trillions of dollars of treasury positions and massive interest rate swap positions. He's talking about MSTR. Doesn't make any sense. I think he's probably got a position, or one of his desks does, on this rebel. And he's talking his book.
What's a simple framework he and his team use to evaluate an investment opportunity that's applicable for retail?
So I think retail probably is more concerned about liquid trading, and I think you really have to have a belief in what you're trading, because belief and use no leverage. It's just hard. Obviously we trade in the early stage stuff, but again, we get access to the best deals and we get the best prices because of who we are. And even still, we lose money on stuff. So I think if you're a retail person, focus on liquid altcoins that, have real organic demand because their product or service is useful, and trade those. Again, if you are not a professional shitcoin trader and you aren't in the Discord, on X, understanding the sentiment behind these things, can discern whether what someone says in a white paper is bullshit or not, just don't get involved because you're going to get burned.
Arthur Hayes pointed out that many crypto traders lost money on October 10th, not due to any Binance or market maker plot, but because they skipped reading long available exchange documents and policies. He said proper traders have no excuse for getting liquidated, except those hit by API glitches, as this reflects the market's maturation with more newcomers treating trading like a casual hobby after work. These folks grind charts without grasping flows, product mechanics, or math, leading to wrecked positions from mismatched expectations and minimal effort. Professional trading demands full commitment, like a job. Arthur Hayes noted he capitalized on the dip, buying back into smaller wallets for coins like Pendle, Athena, and EtherFi at April lows or below, as these profitable projects with buybacks and real users got oversold post-event. He holds a large Ethereum position, but expects liquid alts like Athena to outperform it in the short term, while still seeing Ethereum hitting $10,000 or even $20,000 by cycle end. This would be fueled by narratives like banks adopting Ethereum for secure Web3 via L2s or mainnet in a favorable macro setup. On MicroStrategy, he dismissed index inclusion debates as minor, suggesting Jamie Dimon's comments likely stem from JP Morgan trading desk's positioning for rebalances. For retail investors, Hayes advised sticking to liquid altcoins with genuine product demand and organic use, avoiding leverage or early-stage meme coins unless deeply engaged in communities to spot hype from substance. Otherwise, losses are inevitable. Do you agree that leveraged crypto trading demands 24/7 vigilance on mark prices and auto-deleveraging mechanics? Or can casual after-work traders still succeed without full immersion? Please drop your thoughts in the comments below, share this video, and hit your thumbs on the like button. Thanks for watching. Don't forget to subscribe.